Hi, I'm Victor, and welcome back to the Invest in Value channel, where I'm looking for investments that will reward you with long-term investment appreciation. And today, I wanted to talk about bonds. And I wanted to begin to talk about how one can diversify with bonds going into the second quarter of 2022. So before I do that, let me ask you for a giant favor, which is if you could like my video, I'd greatly appreciate it. And consider subscribing if you'd like to see some more videos as I analyze investments of a variety. I'll mostly do stocks, but I'm looking at bonds to diversify this year. Also review real estate and cryptocurrencies. Now back to the subject at hand. This year, we may see bonds outperform stocks. And I know that's kind of a crazy thought, but I wanted to review some data and begin to think about certain scenarios that could take place in 2022. First, it's no secret interest rates are rising very quickly and have really made certain investments palatable this year in bonds. Now, over the course of the last 5 years, I'm looking at Google Finance and looking at some charts. Really starting with the S&P is kind of like the standard that we compare our investments toward. I compare my portfolio against the S&P, and I wanted to begin to kind of look at where the S&P has been in the last 5 years. More importantly, where it's been in 2022, and where it might end up by the end of the year. So first, over the last 5 years, there's no question, stocks have been on a tear. Look at this graph. The S&P is on this blue line. It's just been such an awesome, upward ride. Now, we haven't had a real solid, natural recession to make that S&P go down. The last real natural recession we had was the Great Recession, which happened was the real estate-led, subprime, lending-led recession, where we saw the S&P drop, for a few years, and it really remained flat for a while, and it took several years to get back to even, for the entire S&P. And before that, we had, the dot-com bubble, where, high growth stocks really tanked, and we had a correction there. But other than that, you look at that, it's kind of like we're missing one. We had kind of a quick recession for COVID, but very quickly the government, entered the picture and just started stimulating the economy like crazy. They were stimulating with, giving individuals money. They were giving companies money to keep employees employed. There was just so much stimulation to the economy. It really caused a very fast appreciation of stocks, real estate, and all kinds of things. Well, they're turning off that. They already turned off the spigot of stimulus, and now they're going the other way, which is increasing interest rates. So with that in mind, as you look at the first quarter of 2022, we've already have begun to see some new trends that I would say could bring bonds to the forefront of how to protect your gains that you've had for the last couple of years, or even potentially the last 20 years if you've been a long-term investor. And I'd like to begin to talk about that. I'll record videos on bonds, probably once a month, because I'm tracking the bond market. I'm putting money there because at the end of the day, all those gains that I had in 21, 2020, and even before, I want to protect those gains. I don't want to ride the S&P. It's been on a wild ride this year. So let me show you what I'm seeing here on the graphs. So this is the max line, but let's look at 5 years. So for the last 5 years, no question, the S&P, you've been, rewarded handsomely for seeing the S&P. But you could see that the beginning of 22, we've seen some a lot of volatility. I don't expect that volatility to stop. It's going to go throughout the year. That's my expectation. I can't tell you if the S&P is going to be positive or negative at the end of the year. All I could say is that it's going to be wild. The Federal Reserve has to increase interest rates. They have to slow inflation down. and they're going to have to use a blunt instrument of slowing down the economy. That's going to hurt a lot of industries. So as I move the graph from 5 years to 1 year, the data begins to kind of compress, right? So we still have, the S&P is doing great. We've seen a lot of volatility over 1 year. We were still positive, but a lot of volatility. And you're seeing that, especially this orange line, the inflation protected bond is beginning to show up. At this point, this is in the March timeframe, is right there with the S&P. Now let's go with the year to date. Now the S&P is showing that it was way below bonds for the first quarter, and it's recovered. In late March, we had a rally back that we came back, but we're still down more than 5% on the S&P. Meanwhile, inflation protected bonds have been doing, have been preserving their positions well. And on those bonds, I know I've invested in I bonds, they pay more than 7%. So you're preserving your capital and getting paid 7%. So this year, if we see that volatility, if we see the S&P continue to go up and down, more down than up, and you end the year with the S&P going down 5-10%, I think the bond position is going to look pretty smart, because you're going to preserve your capital while you're being paid a big dividend. Bonds produce dividends. The other bonds that I'll point out, that's the inflation protected bond type. This is one mutual fund that invests in that type, the long-term bond. Long-term bonds, this is an interesting chart. The reason the long bonds are so low is they're already committed to a low interest rate over a long course of time. And since interest rates are going up, the bond prices are going down. But I believe I'm putting money into long-term bond funds because, okay, the prices have dropped, and I think it's going to stabilize. And again, I'll be able to buy into a position of a risk-free investment. I'm going to give you paid a dividend, and I believe it stands a chance at outperforming the S&P. This year, that's going to be important for me. And then last, short-term. Short-term's pretty much, I guess, outperforming the S&P this year, and short-term can adjust as interest rates go up. So that's another play, especially to hold cash that I don't have anywhere to go with. I'm putting it in short-term bonds because, it is a little tricky this year. You have to be a very good stock picker this year and get into the right positions and avoid the wrong positions, because we've seen some very drastic moves downward in a lot of positions, especially growth stocks. So I'll be tracking this every month and seeing where bonds go. I hope this gives you, a little bit of visibility on bonds and gets the ideas, generating on your side so you can protect some of those gains. When I, probably about 20 years ago, Bill Gross, the bond king, I believe his nickname was, he would have a fund of bonds that would compete with mutual funds. He made a bond fund produce 8-10%. And in that time, it was somewhat normal. And he was, making that kind of return on a very low risk investment. Bonds are far more stable than stocks. And those days have long been, long in the past. Over the last 10 years, I can't tell you that bonds have been a great investment. They've been a horrible investment, but they may be coming back. And right now, again, I'm looking to diversify. The stock market we've had over the last, 5 years, not sure we're going to have that stock market for the next 5 years. We have to be, more careful, really analyze all options, analyze bonds, analyze crypto, so that we can, hold some of those gains that we've had over the last couple of years. So that's my quick review on bonds versus stocks. And I hope you enjoyed, the video. Please leave some comments if you have an opinion on this. I would love to hear what you think is going to happen, bonds versus stocks this year. And do me a giant favor, please like my video, consider subscribing. And again, leave me comments to help me improve the video, improve this channel. And with that, I want to wish you the best of luck in trading this year in 2022. And I really thank you for watching this video.